June 10, 1999, the day the New York Stock Exchange saw Lernout and Hauspie's shares skyrocket past $300, was the moment the world believed it had finally cracked the code of human speech. In a single breath, a Belgian startup that began in a modest garage in Brussels was suddenly hailed as the undisputed king of speech recognition, its name whispered in boardrooms from Silicon Valley to Tokyo, its logo flashing across television screens in 3 continents. Yet beneath the dazzling headlines and the glossy press releases lay a fragile edifice built on inflated contracts, aggressive accounting, and a relentless chase for market dominance that would implode in a spectacular collapse just 2 years later. Founded in 1987 by 2 visionary engineers, Joe Borg Lernout and Paul Hauspie, the company set out with a simple, audacious mission: teach computers to understand the spoken word as naturally as a human ear does. At a time when dial-up modems were still the norm and mobile phones were clunky bricks, the idea of real-time translation, voice-driven dictation, and automated customer service seemed almost futuristic. The duo's early prototypes, tiny speech-to-text engines that could transcribe a single speaker with surprising accuracy, caught the attention of European telecom giants, and a cascade of government grants and venture capital began to pour in. The early 1990s saw Lernout and Hauspie transform from a niche research lab into a rapidly expanding multinational. By 1994, the company had acquired its first foreign foothold, buying a small American firm, Dragon Systems, whose technology powered the first commercially successful dictation software for doctors and lawyers. This bold move gave Lernout and Hauspie a coveted foothold in the United States and opened doors to the burgeoning market for speech-enabled personal computers. The next few years were marked by a string of high-profile acquisitions across Europe, Asia, and North America, each promising to add new languages, dialects, and market channels to the company's portfolio. By the mid-1990s, the narrative was unmistakable: a European unicorn racing ahead of Silicon Valley, armed with patented algorithms that could decipher Mandarin, Arabic, and Swahili as easily as English. The company's revenue grew at a compound annual rate of more than 80%, and the press lauded its CEO, Joe Lernout, as the father of modern voice technology. The firm went public on the Brussels Stock Exchange in 1995, and within a year its market cap surpassed Euros 3 billion. Investors were dazzled by the promise of a future where every phone call, every dictation, every voice command would be seamlessly captured, stored, and analyzed. Yet, even as the stock price surged, warning signs began to flicker in the shadows of the boardroom. Analysts noted that the company's revenue growth was heavily reliant on a handful of massive contracts with telecom operators in Asia and the Middle East. These deals, often sealed in opaque, soft money arrangements, were contingent on future licensing fees that were difficult to verify. Internal auditors complained about the lack of detailed documentation for the sales, while the company's finance team pushed aggressively to recognize revenue at the moment of contract signing, regardless of whether the technology had been delivered or even tested. The pressure to sustain a meteoric growth curve intensified as Lernout and Hauspie's shares became a darling of the dot-com boom. In 1999, the firm announced a staggering Euros 1.6 billion acquisition of a Japanese speech technology company, promising to unlock the Asian market and double its language offerings. The deal was financed largely through cash on hand and a flurry of convertible bonds, inflating the company's balance sheet with debt that would later prove untenable. Meanwhile, internal emails leaked years later revealed a culture of win at any cost, where sales teams were incentivized to close deals on paper, even if the underlying technology was still in prototype stages. The first cracks appeared in early 2000, when a series of European telecom partners publicly questioned the delivery timelines of the promised speech engines. Customers reported that the software failed to meet accuracy benchmarks in real-world conditions, especially in noisy environments, a critical flaw for the call center market the company was targeting. Analysts began to downgrade the stock, warning that the company's aggressive revenue recognition practices could be masking a shortfall in actual cash flow. Yet the market, still intoxicated by the hype, largely ignored these murmurs, and the share price continued its ascent, peaking at an all-time high in the summer of 2000. The turning point arrived on October 23, 2000, when a short-selling firm released a detailed report alleging that Lernout Hauspie had inflated its revenues by as much as euros 1 billion through fictitious sales to shell companies based in the Cayman Islands. The report cited internal documents showing that contracts were signed with entities that had no real operational capacity, and that the company had booked revenue long before any software had been delivered or installed. Within days, the share price plummeted more than 40%, and regulators in Belgium, the United States, and the United Kingdom launched investigations into the alleged fraud. In early 2001, the situation spiraled into a full-blown crisis. Auditors from PricewaterhouseCoopers, who had been the company's external auditors for years, issued a qualified opinion on the financial statements, refusing to sign off on the 2000 accounts. The Belgian financial regulator, the FSMA, froze the company's assets, and the U.S. Securities and Exchange Commission opened a fraud inquiry into the firm's American subsidiaries. Subscribe to The Collapse for more stories like this.